Check, please.
Welcome back to Everything Money. It's Seth, Paul, and Mo. In this video, we will discuss the idea of diversifying your portfolio, a very interesting topic for new and young investors. I will ask two guys that manage over $100 million in real estate, business, and stocks, what a normal person like yourself watching, how I should diversify, if I should diversify, what I should diversify in, whether it's all three of those things I just mentioned, or specifically my stock portfolio. Should I get into Bitcoin? Should I get into crypto? There's so many different opinions out there, Paul. I don't know, and maybe you don't know who to trust. I bring you Paul and Mo and their thoughts on diversification. We will use our software to give you some examples as the video progresses. Go ahead, Paul. What do you think?
So Warren Buffett, people have said Warren Buffett speaks out of both ends of his mouth. I do not think he does. Warren Buffett preaches diversification for the average investor. What does that mean? He believes in buying a low-cost ETF, kind of like SPY. We talk about SPY all the time. Isn't VOO one as well?
Yes, VOO, yep, Vanguard.
SPY, VOO. These are two ETFs that follow the S&P 500. So instead of buying an actively managed mutual fund that'll charge you around 1% management fees, this is like 0.09% management fees. And this is like 0.1% or something crazy like that.
So you're buying a huge baskets of stock. And
you're buying 500 stocks.
500 companies, yes. And so
500.
You're kind of diversifying your portfolio
there. You're already diversifying.
I see.
So if you have a diversified portfolio of 20 or 25 stocks, that alone eliminates market risk, according to studies that have been done. Now, I'll go look at Warren Buffett, what he's done in the past. When he started his fund, Mo, how many stocks did the guy hold?
Oh, it was very few.
8, 10 stocks at a time.
Very few, yep.
He would have no problem taking a 20% position of his portfolio into one stock.
Yeah.
But why is he allowed to do that? Why can he do that and we should not? The average person.
Tell me.
The guy
he can do that.
Is brilliant. He's reading financial statements. He's reading footnotes. He's interviewing CEOs. He's getting on the board. He is so actively managed.
So he's doing the work that a normal viewer can't. He recognized Coke. He recognized Geico. He recognized this a long time ago.
Long time ago when he was willing to sit there and do the work necessary. I'm a fairly lazy value investor. I am less lazy than you, but I'm a fairly lazy value investor. I don't want to go interview companies. I don't want to interview CEOs. I want to look at the numbers and pick a basket of 20 or 30 or 40 stocks that fit my criteria. I'm even big on diversification, right? So when people talk about diversification, it's funny. I'll hear people say all the time, diversification is really important to do for everyone. Well, not necessarily. If you're willing to do all the work in the world to get intimate, detailed knowledge of a company, you should not be diversified. Look at it this way. Most people out there have one piece of real estate. That's not very diversified.
That's not diversified.
That's your house. Are you diversified there?
Oh, I see. So
No.
a housing market crash would drastically affect your bottom line.
How's your diversification in your relationship? How many marriages you got? One.
I currently have 4 right now. But
We don't do diversification in a lot of things.
Should we stricken that from the...
And we're okay with that. But with investments, guys, you need to be doing so much more research in these companies that it's not even possible. So I would just recommend doing this. Now, if you like the things you watch in our videos, our over 1,000 videos we have on our channel, if you like our software that we have out there and you're a subscriber of it, and you want to do more intimate knowledge and more detail, more power to you. But even then, I would recommend 20 to 40 stocks that fit a certain process and criteria. Because you're still not going to do the level of detail analysis that Warren Buffett or our good friend Gary Masuris does.
Yeah. Not only, there's often cases like what Gary does, you can't do that because you can't contact that CEO, et cetera. So,
because we're looking at bigger companies.
Exactly. We're looking at
multi-billion-dollar companies.
$100 billion plus companies.
Gary has no problem looking at a $20 million company.
Correct.
I don't do that.
And trying to get a board seat, et cetera.
I'm not trying to do that. What I'm trying to do is sit there. For me personally, what works for me, not necessarily what works for Gary, not necessarily what works for you, I like to pick a certain parameter of metrics that I like on companies that are over 10 or $20 billion in value. But the reason is, I like to sell options against that. It's another form of diversification for me. I like to get another income stream that way. Now, that's not necessarily available to everybody because you have to have 100 shares at a time to do that. But the point I'm trying to make about it is, everybody is different. I have 8 or 9 businesses upstairs. I have hundreds of units of apartments growing to several thousand at some point in the next 10 years. I've got a nice portfolio, as Seth mentioned before, of stocks. I have multiple ways to make money. I already am diversified. So I can make more pointed investments in certain things within just my overall portfolio, so diversified from businesses, real estate, and stocks, that I can take more specific investments if I want to. Like even our real estate, we have 600 units, and they're basically in 2 specific areas of Cleveland and Columbus, and that's it. So you might make the argument of, even though I have a lot of real estate,
Not diversified.
they're not diversified.
Yeah.
Literally the ones in Columbus are within 1.5 miles of each other. All 500 units in Columbus are within 1 mile of each other.
Yeah, being diversified is a very subjective statement.
Yeah, it's a talking point that everyone kind of throws out there. This is the point of this video. So Paul, say we have someone watching, viewers maybe somewhere between 24 and 40 years old. They're investing their first $1,000 in their Roth IRA outside of work. Being diversified would include what, Paul? Like I mean, what would that include? What is our mindset moving forward for our first investments?
Especially with less amounts of money, I would take the dollar cost averaging, which is every month, pick the same amount of money, $1,000 a month, whatever the number is, $500 a month, and buy VOO or SPY month in and month out. Because remember, I've shown this graph so many times. This is where the stock market value should be over time. This is what the stock market price does. You can't possibly guess this point or this point. So your job is to buy every single month, month in, month out. And over time, you will pay the average. And you will get this graph on your money. You will overpay sometimes, you will underpay some. You'll overpay and you'll underpay. But overall, you'll pay this.
Guys, what I do with my retirement account is I just buy with my Roth account, I just buy the S&P.
Do you really?
Yeah. Figured with that amount of money, contributing $6,000 a year, why bother? Just put it in there and let it go.
You're right.
Know?
Yeah.
So another option you can move up to if you're watching at home, say you know all this and you want to level up. This is where we introduce our 8 pillars. So we went from saying, okay, you know what? I'm fine with SPY, but if I can make not just 10%, 11 or 12 over a lifetime, it can transform our retirement wealth by millions.
Let's do that right here.
Yeah, let's say we developed, go ahead, Paul.
So guys, this is our Everything Money software. It's right here, very simple. I go to the right, retirement calculator. Let's put in some numbers here. 30 years old, retiring at 65, current savings, let's say it's $20,000.
I was going to say the same thing, yes.
Annual savings, let's say it's $5,000 a year. That's $50,000, let's go to 5. And you're gonna increase your savings rate by 4% a year. Annualized returns. Let's say you do an ETF, and let's say after fees you get 9.5%. And during retirement you get 5%. If you're gonna live to 100, and inflation is 3.5%, and your current income is $60,000 a year, what percentage of your income do you want to have in retirement? Let's say you want to live a better version of retirement. You want to live 50% better than you do now. The great thing is it already tells you don't have enough to retire. So you can have the reality of, oh man, I gotta save $14,000 more per year. Or let's extend my retirement age. I go to 70. I only need to save $6,800 a year. Okay, forget that. Let's look at the annualized returns. Let's say the 9.5% becomes 11%. 1.5% extra.
2.5?
1.5. 9.5 becomes 11.
Oh, I thought you said 11.5. Sorry, go ahead, Paul.
So at retirement, you're gonna have $2.5 million at 9.5%.
Oh, wow.
At 11%, you're gonna have $3.6 million. That 1.5% difference is 7 figures in gains. And guess what? You only need to save $2,400 extra a year versus $6,000 extra a year. It's gonna save you money today and give you more in the future. Think about that for a second. 1.5% difference will save you $4,000 a year today and give you over $1 million extra in retirement.
And that's where a lot of these mutual funds can hit you, because maybe you go from 9.9% down to 7%.
So let's do that right now.
Do that one right now.
Let's say you invested in a mutual fund at 7% return.
Remember, your fees are more expensive now.
From $6,000 you have to save to $17,500. And now in retirement, age of 65, you only have $1.4 million. $1 million less.
Yep.
That's what's incredible about all this stuff, guys, is that this software we created because our users wanted it from us. We created it to show you guys the real numbers out there. So if you do want to step up your game and understand real numbers, we go to the 8 pillars. This is how you understand our stocks. Let's say you pick a company like Intel. You go to Intel, you look at the metrics here, you can get their annual reports, Go to the income statement, shows you income statements for their history, balance sheet, cash flow, and our not patented, but really exclusive 8-pillar process, all 8 check marks. Then you can go to a stock analyzer tool, put in your assumptions on analysis, how many years you want to go out, how many assumptions you want to make, what return you want to make, and it'll tell you exactly what you should pay for the company based on your assumptions.
So Paul, what I'd like to do, the final piece of the puzzle is if you pull up one of the tools we offer in the software is the 8-pillar portfolio. You can build a basket of stocks. Again, this is leveling up from SPY. This is leveling up from maybe a process like the little book that beats the market, a book out there by Joel Greenblatt. But you can look at a total portfolio of stocks you might own and see how they fare as a full basket.
Yeah, so the reason we did that is you might have stocks that aren't a full 8 pillars, but they're still a good buy because they're growing like crazy. And that's what we're trying to teach here too. A slow growing company, you need it. We just looked at a company in another video, it was all 8 pillars, and we didn't buy it. Why? Because it was so slow growing that the return we wanted to make, you had to pay a much lower price for. So on this 8 pillars portfolio, you can input all your stocks in your portfolio, hit get stats, and it'll tell you everything about the 8-pillar portfolio together.
So Paul, show people the 8-pillar portfolio tool we have in our software.
Well, what it does is basically allows you to take all these stocks in your portfolio, put them in our 8-pillar portfolio, and show you the overall 8 pillars of your entire portfolio, not just the individual company. So it's just like Moneyball. Brad Pitt, when he was in Moneyball, was saying, here's our average OBP by the 3 players we lost. We need to replace those 3 players with other players that average that same number. Same thing here. You might have a 6-pillar stock with an 8-pillar stock, but overall together, they're still an 8-pillar stock because the 8-pillar one is so good on their numbers that it makes up for it. And that's part of the whole process of building a good portfolio. I'm not telling you should have an 8-pillar portfolio. It is nice to have that. I think over long periods of time, you will do very well if you have that, but we have not backtested that. But this is all part of diversification. That's why the 8-pillar portfolio is such a useful tool for people who subscribe to our software to get everything. That way they can sit there and put it in and say, okay, I'm diversified and my diversification is in good companies that have good financials.
If this interests you, stay with this channel and watch more of our videos. You can trade with Trader Mo in the charts over there. Totally different mindset behind diversification and long-term savings, but Mo can walk you through that guide. Mo, tell them what you're doing in the Bid and Ask Nation with trading.
It can definitely help you diversify a little bit, but if you don't want to sit on your hands and you get anxious, this is a great way to get in there and be more active and make a little bit of money while you're doing it. In the Bid and Ask Nation, we have the Employed Trader series. There's so many, which is 6 stocks that I tell you which to buy and sell each day. We have all of my teaching videos, all of my teaching seminars, a great community of other traders in there. If this kind of pattern recognition and chart reading speaks to you, or it's something that you've always wanted to try, this is the place to be, Bid and Ask Nation.
That is our take on diversification. Again, we appreciate you guys watching the videos. Learn from us. We will be here from you. We've been doing this for 3 years, and we will be here for a long time, guiding you through this process, utilizing our software to make better financial decisions moving forward. You can fire that financial planner who's charging you all those fees and build wealth on your own. Thanks for watching. Fondle the thumbs up. See you in the next video.